I'm Sebastian St. James. You are trying to borrow too much, according to APRA. Who's APRA? Why can he tell me how much I'm allowed to borrow? APRA is the Australian Prudential Regulation Authority. APRA has the job of regulating the banks in Australia. They decide how much you can borrow and how much is risky. Is the amount that Australians are borrowing right now considered to be risky according to APRA? Yes, it is. And you may be caught up in all of this. When you apply for a loan, you become a jumping horse in a show. This is true. There are a number of hurdles that you have to jump over. Each one of those brings you closer to being accepted for that loan. Here's the first one. Hurdle number 1 is DTI. Can you surmount DTI? Well, it depends. What does DTI stand for? I'll tell you whether I can surmount it after that. DTI is your debt-to-income ratio. So the debt is the amount that you want to borrow. The income is your total income per annum. Divide those by each other and you get the DTI. Let's say that you want to borrow, your income is $100,000, 5 over 1, the DTI is 5. Is that good or is that bad? That's very good. A DTI of 5, that is acceptable, but some DTIs are not. I'll let you know. APRA has just changed their rules of what is an acceptable DTI, and these are affecting banks today. This is brand new news, just released, and I'm going to tell you all about it. Previously, APRA's DTI is 9. There you go, 9. It is now down to 8. So they've subtracted 1 and the amount you can borrow therefore is considerably less. Let's see how that could affect you. In Australia, the median income is $1,209 per week. That makes it $62,868. Previously, you could borrow at a DTI of 9, $565,812, but now you can only borrow $502,944. This is per person. If you have double income earners in your house, then you can double this amount. $565,812 minus $502,944 is $62,868,000 less. That's how much less you can now officially borrow according to APRA. As a result of this change from 9 down to 8, two Australian banks have moved to curb their risky lending practices. Which two banks are they? Are they banks that you may be borrowing from already or want to borrow from? I'll tell you. ANZ told mortgage brokers that from June 6 it would no longer make loans to borrowers who would owe more than 7.5 times their annual income. 7.5, APRA says 8. ANZ says no, we'll take it to 7.5. Take that. Now, that is down from a previous cap of 9, so they've gone from 9 down to 7.5. That's ANZ Bank. What about NAB? NAB lowered its debt-to-income ratio from 9 to 8 times. There you go. So NAB is only going to APRA's level. They're not taking it below that. I've got a video coming out shortly to tell you how to save a deposit for a house. So make sure you're subscribed so you don't miss out. What is a risky DTI, debt-to-income ratio, and is that affecting you now? Is your loan application that you're putting in potentially risky? Well, the answer is 6. 6 what? A DTI of more than 6, according to APRA, is risky. But aren't they allowing up to 8? Sure they are, but anything greater than 6 is considered to be risky. So there you go. You now know. 6 times the median income is $377,208. So if you're asking more than that per average person, per single person in a household, so double that if you've got double the income, then any more than that, you are considered to be a risky applicant. Are risky loans common, or are Australians applying in a way that makes APRA comfortable? Almost a quarter of new loans have a DTI of 6 or above in the second half of last year. So a quarter of people who are watching my videos now that are applying for loans are risky. I know which ones you are. Banks are becoming too risky as well. Yes, this is true. The APRA chairman confirmed he has contacted some banks with concerns about the level of high DTI loans they were issuing. A naughty note from APRA to your bank. This means that your application to your bank may have got your bank into trouble. Yes, take that. And I expect you to write an apology letter to your bank at once. The APRA chairman has said, "We will be watching closely the experience of borrowers who have borrowed at high multiples of their income, a cohort that have grown notably over the last year." Well, interest rates are going up, so that sort of goes with the territory. So, which banks are risky? Which banks are considered to be safe by APRA? Or are they all the same? We opted to tackle our concerns on a bank-by-bank basis rather than opt for any form of macro-prudential response. Interestingly, this growth has not been an industry-wide development, but rather has been concentrated in just a few banks. Well, there's only 4 major banks in Australia, so is it all 4? No, it's not, but it is 2 in particular. I wonder if you can guess which ones are affected. Is your bank responsible for these risky shenanigans? I'll let you know. Westpac and CBA both said they have not made recent changes to their policy around high debt-to-income ratio loans. Well, that's good news. ANZ and NAB have. That's right. They received a naughty note from the teacher and they have responded accordingly. Westpac said all loans with a DTI of 7 or more are sent to manual assessment for its credit team. So if you're below 7, it's automatically you go through to the next hurdle. Remember, there are a number of hurdles that you have to go through. I'll tell you about another one in just a minute. But if you're above 7, then sorry, you're going to be scrutinised to the nth degree. Hurdle number 2 is the interest rate rise stress test. What does this mean? This is based on the idea that the interest rate is here now. But guess what? It could come up to here. Therefore, can you afford to make repayments at the new potential higher level? I mean, how much higher? We have those numbers. From November, new borrowers have had to be tested to see if they could cope with interest rates at least 3% above their current rate, up from 2.5% previously. So now you need a bigger threshold of safety as far as you being able to repay your loan. Why? Well, because the interest rates are going up. Before they weren't. So 2.5, that was no problems, but we know they're going up now. So therefore, APRA has taken it up to 3. So which is more a concern? The levels coming down from 9 to 8 or the interest rate serviceability going from 2.5 to 3? According to Sally Tyndall, debt-to-income ratios are one small piece of the serviceability equation. Rising interest rates in particular are far more likely to have an impact on people's home loan applications moving forward. So there you go, you've answered that one. Is there a crisis on our hands? Are we going to have a mortgage default right across Australia? And are we going to have a 2008 style US default all over again right here in Australia? APRA chairman said the regulator was not worried about the potential for widespread home loan defaults across the banking sector, but it was more concerned that some borrowers, especially recent ones, may be under severe financial stress. Are you under severe financial stress? APRA may think so. We are now entering a very different environment that has existed for much of the past decade, he said. The faster than expected emergence of high inflation and interest rates will have a significant impact on many mortgage borrowers, with pockets of stress likely, particularly if interest rates rise quickly. As expected, housing prices fall. Housing prices are expected to fall? Yes, according to APRA, they are. Of particular note would be residential mortgage borrowers who took advantage of very low fixed rates over the past couple of years and may face a sizable repayment shock, possible compounded by negative equity when they need to refinance in the next year or two. So what is this negative equity that APRA is talking about? Let's say that you borrowed $500,000. Your house is now only worth $450,000. That means you are minus $50,000. If you were to foreclose your loan right now and the bank was to take back your house, that's a problem for the bank because your house would actually get less than what you owe. Therefore, that is negative equity. Recent borrowers with small deposits are particularly at risk if home prices fall, according to APRA. This negative equity is such a big issue that it actually affects the way you borrow. You may know that when you borrow, you need to put down a deposit, and typically that's around about 20% if you're well behaved. Why 20%? 20% allows for that particular fall. So houses can fall by 15%, 10%, up to 20%, and your bank is not worried because you're not in negative equity. Now, so what happens if you want to put down a smaller deposit like 5-10%? Well, you have to pay pay mortgage insurance. So what is mortgage insurance? That is a level of insurance that you're actually paying for. You're actually paying the fees like a normal, regular insurance policy to protect yourself. No, to protect the bank. It's going to cost you more. That's why that 20% limit comes about, because the bank wants to protect itself against you potentially having negative equity with falling house prices. So what's going to happen as a result of these changes? Can you tell me? Yes, I can. More people will be denied when applying for a loan. That could be you. There will be downward pressure on housing prices as people's upper borrowing limit is slashed. So you may not be able to afford the house of your dreams, or any house. Let's face it. Do you know that credit cards actually affect the amount that you can borrow? Oh, I've got a credit card, but I've got nothing on it. I keep a zero balance. It's just there for emergencies. Well, that's a problem, because that is going to affect the amount that you can borrow. And here's how. Let's say you want to borrow $600,000 from the bank. You have a credit card balance with $0 on it. Hooray! Everything is going fine. Now, your credit card limit is actually $50,000, but that's okay. You're not using that, are you? No. But the bank thinks you might, and therefore it deducts that from the amount that you're allowed to borrow. Now, instead of $600,000, you are only allowed to borrow $550,000. But I'm not using that $50,000, but you might. Technically, it's there. You may go ahead and use it. We cannot afford to risk giving you that money. And therefore, if you have any credit card at all, you will be able to borrow less. So what should I do with all this information? Well, the first thing you should do is to realize that if you're applying for a bank loan and you're applying for more than 6 times your annual income, the bank will consider you risky. What does this mean? It means that they will ask you to jump through more hoops in order to get approved. So that 6 times is the secret magical number under which you're considered to be low risk. Potentially downscale the amount of the house that you think you can afford, because remember, the lending ratios are now being dropped, so you may have to curtail the sort of house that previously you would have been able to get into, but now you won't be able to afford. And potentially get rid of any credit cards. If you don't need them, or if you absolutely can, get rid of them, because they do affect your borrowing limit. If you're struggling to repay your loans, or you think you might, then you need to downsize your costs. I've done a video on that. Go ahead and watch it now.